Hello. In this video, we'll be talking about diluted earnings per share, second part regarding convertible securities. Let's talk about basic earnings per share before we go into diluted. And earnings per share is a number that is widely used by investors and creditors alike. It's one of the most important ratios that is used on the market because it's really telling and very easy to understand to most people. So in the most basic terms, earnings per share is how much earnings does a company have for every share of stock that is outstanding. So if you own a share of stock, it tells you how much earnings does the company have for per that one share. It is not the dividend that they're going to be distributing. It's just an earnings number that it's information. There's two types of earnings per share. The first one is the basic earnings per share, and all companies must report their basic earnings per share. And in simple terms, earnings per share is the earnings available to common shareholders divided by the weighted average number of common shares outstanding. And earnings available to shareholders, what that ends up being is the company's net income minus any preferred dividends that are paid or distributed or owed. Like on a cumulative preferred dividend, they would be owed. So this entire video assumes that you've seen the basic earnings per share video plus the first part of the diluted earnings per share video. So I'm going to go through this very, very quickly. A complex capital structure is a company that has securities that have the potential to have more common stock issued either through their exercise, conversions, or issuance. Any company that has a complex capital structure is required to report two different earnings per share. They're required to report their basic earnings per share, which ignores all these dilutive securities. And they have to report their diluted earnings per share, which incorporates basically all of the dilutive effects. Almost. There's some exceptions. And some examples of securities that might end up having potentially additional common shares are convertible bonds and convertible preferred stock, which is what we're going to go through in this video. Stock options, which we went through a different video, and this other item, contingently issuable securities, which we're not going to go through. So what are convertible securities? These are items that can be converted into exchange for shares of stock at the option of the holder. So it could be that more shares will be issued. And when you're looking at your earnings per share calculation, your earnings per share is, I'm going to go net income minus your preferred dividends divided by the weighted average of outstanding common shares. I'm just going to call it shares. So if more shares are issued, then there's going to be, your denominator is going to be larger, thereby making your earnings per share go down. And that's what we mean by dilutive. So, and when we calculate a diluted earnings per share, the rule is you have to assume that all of your potentially dilutive securities are actually converted into common stock at the beginning of the period, or at the time the convertible security is issued, or at the time the stock option is issued, if that's later. So we have to assume they're all converted. Whether or not that's true, it doesn't matter. That's the way diluted earnings per share is calculated. So let's talk about convertible securities and how they affect the earnings per share calculation. So again, the earnings per share is a fraction, and let's go through the denominator first, just because it's just easier. So we assume whether it's a convertible bond or convertible preferred stock, that those bonds will be converted, or stock will be converted into additional common shares. And so in our denominator, right, we have our denominator, our shares will increase. Okay, now there's two types of convertible securities we're going to be talking about. The first one is convertible bonds. Bonds are securities that companies issue to bondholders, right, as a means of raising capital for the company, and the company pays the bondholders interest on those bonds. There are some bonds that come with this feature where the bondholder is able to convert the bonds into shares of common stock instead of being paid out at the end of the bond by the company. And this is what we're talking about, convertible bonds. So let's see how this affects our EPS. Well, if we have bonds on our books, bonds payable, those bonds pay interest, and so the company will pay that interest and they will record interest expense. What does interest expense do to our net income? It reduces it. So if we now assume that these convertible bonds are no longer and they're actually converted into common shares, then now the company doesn't have that interest expense anymore. And now we have to figure out how much of net income is actually going to be increased because we don't have that interest expense. So that's how the numerator will change when we're talking about convertible bonds for diluted earnings per share. Then we have convertible preferred stock, where this is a feature for some preferred stock where the stockholder can choose to convert those preferred shares into common shares. And our denominator is going to go up by the additional shares. And our numerator in the EPS is net income minus preferred dividends. So the preferred dividends are only paid on preferred stock. So if that preferred stock is converted into common stock, then those dividends will no longer be paid, right? And so we have to remove those dividends from our numerator. So that's how these items affect diluted earnings per share. Let's go through the interest calculation related to the conversion of bonds. I'm going through a super simple example, but you'll see why. Okay, let's say we have a company and they have income of $1,000. They have interest expense of $100, so pre-tax income is $900. Tax rate is 30%, so their income tax expense is $270. So when you take the 900 minus your 270, your net income is now $630. So now let's look at that same example, except now we remove the interest expense from the calculation. So this is like if you had the bonds, and this is if they're converted. So now you don't have you're not paying the interest on the bonds because the bondholder converted those bonds into common shares. So now you have no interest expense. So I still have income of $1,000, $0 for interest expense. So my pre-tax is $1,000, tax rate is 30, my income tax is 300. So now when I take 1,000 minus my 300, right, my net income is 700. So if I had bonds, my net income would be 630. If I had no bonds, my net income increases to 700. So my net income has essentially increased by $70. So I just want to, the reason I'm showing you this is because there's a shortcut as to how to calculate the effect of a convertible bond, the interest elimination of a convertible bond, because you have to take into account the tax effect of this interest expense. Because now that you don't have that interest expense, not only is your pre-tax income going to go up, but your income tax expense is going to go up, which makes your net income go back down. So a shortcut to this calculation is you're going to take the interest expense, it's right here, interest expense, and you're going to multiply by 1 minus the tax rate. So let's see, if I take my interest expense was $100, and my tax rate is 30%, and I'm going to multiply that times 1 minus 30%. That's the same thing as $100 times 70%, and here's my $70. So this is a shortcut method to increase. You're going to increase your starting net income, and you're going to increase it by that amount to get to your impact of no interest for the conversion of those bonds. So we're going to go through this example that it's an ongoing example used in the basic earnings per share video and the first video for diluted earnings per share for stock options. So I'm assuming you've watched those already. And in that video, in this situation, there's all these transactions that happened, and we went through each one in those videos and how that had an impact on the weighted average number of shares outstanding. And where we left off in the first part of this video for diluted EPS was that our weighted average number of shares outstanding was 78,000. Now we're going to add this new item for convertible bonds on this example. And the company now has 8%, 300 million face amount, I should say bonds, issued in 2026, convertible into 12 million common shares. Okay, so now we just have to assume that the bondholder has actually converted those bonds and received common shares instead. So we're going to add 12,000 shares or 12 million shares. And so now our weighted average number of shares outstanding is 90. So let's see how that impacted our diluted earnings per share. But first, let's go through our basic, which has been unchanged. We're taking the net income from the company, and they have preferred dividends, and they had preferred dividends of $4. So we're going to remove that. So our numerator is 150. And in our basic earnings per share, our average weighted number of common shares outstanding, it's so long to say, is 75. And I'm just going to go right here back to this slide, and that's where we stop. This is this up to this point in this table, this is where the basic earnings per share is, and all these other items are for diluted earnings per share. So now our diluted earnings per share, we still have our net income minus preferred dividends, but now our bonds have been converted into common shares, so we have to add back the impact of not having that interest expense anymore. So how do we calculate that interest? We're going to take the percentage on the bond times the face value of the bond, which was 300 million. So we have to add back, so 8% times 300 is 24. So we're going to add back 24 times 1 minus 25%, because we're told that the tax rate is 25%, which is essentially 24 times 75%. And now our net income is $168 million, okay? And our numerator has now changed to 90, and that's based off of, this table right here. So now my new earnings per share for my diluted earnings per share is $1.87. Let's do a concept check. On January 2nd, 2027, Sarah Lawrence Company issued at face value $10,000 of 5% bonds convertible into 2,000 shares of Lawrence's common stock. No bonds were converted during 2027. Throughout 2027, Lawrence had 10,000 shares of common stock outstanding. Lawrence's 2027 net income was $2,025. The income tax rate is 25%. No potential common shares other than the convertible bonds were outstanding during 2027, and we have to calculate the diluted earnings per share. So let's go through it step by step. First is you're just going to take your net income divided by your shares of common stock outstanding. So our net income is 2,025. Our shares outstanding is 10,000. And this, if we were to calculate it, that's it. This is your basic earnings per share number right here. But we have convertible bonds. So how do we account for those? Step one is we have to account for the numerator change for the lost interest expense. So how do we calculate the interest expense? We take the face value of the bond, multiply the rate that's on the bond, so 10,000 times 5% gives me $500, multiplied by 1 minus the tax rate, which is 25%. So when I take 500 times 0.75, it gives me $375, and then I add it to my net income. So right now my numerator has changed to $2,400. That's step one. Step two is that, right, this was step one. Step two is that I have to account for the additional common shares that were issued as a result of the bond being converted. And again, we just assume that all convertible bonds have been converted. And it says that the convertible bonds give us 2,000 additional shares of common stock. So we have to add the $2,000 shares to our denominator. And now our earnings per share is 2,400 divided by 12,000, and it is 20%. So another type of convertible security now is convertible preferred stock. And again, with diluted earnings per share, we always assume that the conversion has actually occurred. And so we're going to have additional shares in our denominator. And then in our numerator, any preferred dividends that were previously taken into account, right, are no longer need to be subtracted, right? Because we had our numerator is net income minus preferred dividends. And so now, if those preferred shares are converted to common, there are no preferred dividends, and we have to add them back. We have to add them back. If we had any subtraction for preferred dividends, we have to reverse that in our numerator. So let's go through this example again, except now we have preferred stock that's actually convertible into 3 million shares of common stock, okay? And everything else is the same. Well, let's go back to our table. We left off where we had 90,000 shares outstanding, but now we've converted our preferred stock into 3,000 or 3 million shares. And so we add 3, and so now our weighted average number of shares outstanding is 93. So that's going to be our new denominator. So first, let's look at our basic earnings per share is still unchanged. Our denominator, right, if we're going to build on, we're starting with our net income. Here, this is for the convertible bonds. In this item we already did, but now we no longer have the preferred dividends. See how there's the preferred dividends being subtracted from net income for the basic earnings per share, but for diluted, we no longer have that, and we have to remove that from the numerator. And so then I have 154 plus, this ends up being 18. And so that gives me a new net income of 172 divided by the additional shares being included for the preferred stock conversion. And my new diluted earnings per share is $1.85.